Investors looking for bullish strategies have several avenues to reach their end goals. We're digging into those strategies via the options trade in the latest installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. And joining us here to discuss is Jessica Inskip. She is the OptionsPlay Director and Education Product Liaison. And let's just jump into this. We got three different scenarios here. So we're going to take long a stock, and we're talking about risk reward because in trading, you want to have a stop or you want to have some kind of management tool there. And so we're going to take a long stock view, long call option, then long covered call option and compare them. So let's begin with long stock, and I'm going to let you set this up.
Absolutely. So especially for my beginner options traders who are out there who've never traded before or any type of trader, we have to focus on risk versus reward. So whenever we're buying a stock, the most that we can lose is the most that we spend, right? But when we're trading, we always have a price target in mind. And these are very essential components when we talk about options. We just add that layer of complexity because it's a derivative of more than just the underlying security. Yes. We've got time and implied volatility as well. So in this scenario, we're just assuming this hypothetical long stock is we're buying at the current market price of $100. We have a price target of $110, looking to make $10, which means our break even, or the most that we can lose in this scenario, is the amount of capital that we spent.
Which is all of it, but
yeah,
yes.
Exactly.
All right, now let's get to another scenario here. Here we go, long call option. Similar, but break this down, how the call differentiates the risk reward.
Absolutely. So same thing. It's important to know that we have a price target in mind. So assuming that we still have that same 110 price target, but now we're buying the call contract for 5. That means that we've got actually I believe this was moved around. I apologize. Yeah. This would be a 105 break even right here is what this is, because we would have a higher break-even price because there's a cost.
I got you.
So if we at the current market price is 100, we'll just say, well, we'll correct it right here.
Thank you.
This is 105. Now we're spending. This is a risk to reward of really, we can only make 50%. That's not very good. This is actually a poor scenario. Yeah. And I think one of the biggest risks of people going into options is they're going to start by buying calls. And if we're buying this call for 5, what you don't realize is that this is $5 from that 100 price is something you have to overcome before you actually become profitable. And that's assuming at expiration, but that's why those other factors are important. And the risk of starting out with options this way, it's important to know how pricing is really comprised.
Yeah, and price, so all your premium can go out the window. That's just time decay right there.
Absolutely.
So let's, instead of buying this option, let's look at another scenario here. And here we have a covered call. And first, we're going to give you the definition. Investor sells a call option at a set price and expiration date on a stock that the seller owns, that's very important, in an equivalent amount. So I have to own the stock, and then I can sell a call above the current price. And here's what that looks like.
Yeah, and I see where the issue came up. It's on the previous slide. This one's 97.
Got you. We're gonna fix
I apologize for that. But so we'll say this one's 97. So here's the difference though. And I'm glad we can write it down.
Yeah.
Now we're receiving that $3 premium. So in comparison to that 100, we've now reduced our risk exposure because we're receiving upfront. Exactly. So if this line here represents owning the underlying security.
Right.
Have the same substantial loss potential because the most that I can lose is what I can spend. I own a stock at this point. I'm selling the covered call, so therefore I'm bullish. I'm utilizing the stock as collateral because I'm obligated to sell my shares at the strike price, in this case, our price target of 110, but I'm reducing my risk right here by $3.
Shifting it left there.
Yes, ever so slightly. Now, with options, there's a give and take. The give, of course, is this premium reduction of $3. The take is capped up towards potential. If I own the stock, I theoretically can hold it indefinitely. It can go up to an unlimited amount. Here, I'm capping my gain potential at 110.
All right, so limited upside, and again, we got the potential of 100% loss, but you've put some money in your pocket. We got about a minute to go here. We got lots of risks and also some rewards. Risks are leverage, complexity, time decay, and option. And I'm going to give you the floor here in a second. In terms of benefits, we got leverage, hedging, defined risk. What's the message? You got one message you can give options traders starting out. What is it?
Never hold an option till expiration. That's the worst thing you can
I've
do.
done this, by the way.
It's risk. If you hold the option, you lose giving up the time value. And then if you are short the option, then you actually have what's called gamma risk, and you have a huge issue of being unprofitable very quickly. So trade small, trade often, as they say at Tasty Trade.
Trade small, trade often. I really love that. Jessica Inskip, thank you for joining us.